Why bond yields are falling. This is just off the video I did 2 days ago. How your old buddy Josh, is making money in long-term U.S. government bonds. So Schwab agrees with me. Let's take a look, shall we? First, I want to point out Prairie Mark had made this comment, which I was going to respond to, but I'm going to do it right now. He says we are at risk every time the Fed changes buying patterns. They can raise or lower rates at will by buying or not buying bonds. Don't you think that's what's happening the last 2 weeks? So Mark is saying the Fed is buying bonds. It's not happening. 10-year treasuries are down more than 50 basis points in a few weeks. Do you think that's because the average Joes like Mark and his friend Josh are buying bonds and driving interest rates lower? Or, Mark says he doesn't think that, or because the Fed is buying. I do think that. If they do buy a lot of bonds, they can keep the interest rates artificially low, and that creates bubbles. All right, hold on a second. Okay, just come on up, though. Jeez Louise, boo cheese. If they don't keep interest rates on 10-year bonds low, then the bond market can melt down and interest rates can take off in the right direction. And then he says, do we really have a free market? No, of course not, Mark. But that's not what's happening here. The Fed raising on the federal funds rate 75 basis points and turn around buying long-term bonds to invert the yield curve. That doesn't make any sense. And we'll just prove it right here. I mean, just inherently think about it. The Fed's going to raise the FFR, federal funds rate, short term, and lower the short term of the inflation or the yield curve to jump those up and buy long-term rates to keep the rates low, essentially inverting them, because they're going to raise again, this month? I can't remember. All right. That's not what's happening. So let's read what Schwab says. Kathy Jones over at Schwab. The Fed's pledge to curb inflation appears to resonate. Right. And here's the yield curve as of June. Here's the yield curve as of 2 weeks later. You can see short-term rates way high. Hey, buddy. And then it's kind of falling back. All right, so the yields have dropped significantly because people are buying up the shorter end, but they've been also buying up the longer end too. So you can see the yields way high, yield to maturity. A lot of people selling their bonds or just not buying, and then all of a sudden, shoops, just a significant difference. That's just because the people buying them. But who's buying them? That's the question. All right, let's see here. I want to show you something. One reason the Fed has given for such an aggressive pace of tightening is a fear that inflation expectations will become unanchored and thus self-fulfilling. If consumers and businesses believe prices will be higher in the future, they may pull forward consumption to drive demand even higher relative to supply. Okay, that's why we pay these guys the big bucks over at the Fed. All right, let's see. However, market-based readings of inflation expectations peaked at 3% in April and have fallen back since then. The implied 10-year average inflation derived from the TIPS market fell to as low as 2.3% in July. Interesting. So we got commodities dropping right here. It hasn't been front and center lately, but the Fed has begun to allow its balance sheet to decline. Not buying, selling. Pulling liquidity out of the market, the liquidity that's just sitting in the banks anyway. It wasn't making its way to the economy. That's why the velocity was so low. So the Fed has begun to allow its balance sheet to decline. This will contribute to the tightening in financial conditions. As the Fed allows the bonds to mature and roll off its balance sheet, it shrinks the amount of money available in the system. They're literally pushing the bonds back to the banks. They're taking the cash out of the system. As a result, the monetary base, the amount of money in circulation declines. And that way, a declining balance sheet has the same effect as rate increases. Economists estimate that quantitative tightening probably will be the equivalent to 100 basis point tightening. Recently, the growth rate in the money supply has begun dropping sharply after rising during the pandemic. The current year-over-year growth rate in M2 is 6.6%, which is the average from 2014 to 2019. In real terms, adjusted for inflation, that money supply growth is negative, consistent with a tight monetary policy. All right. M2, we talked about M2, but it's a measure of cash deposit, checking deposits, easy convertible near money, time deposit accounts. It's a closely watched indicator of money supply and future inflation. All right. Then she says about future rate of inflation, we don't know, but she goes, we suggest investors look to add more yield to their portfolio, or we suggest investors looking to add more yield to their portfolios, considering add more duration. Exposure to interest rate risk. That's exactly what I did on Friday, right? I bought the long-term government Schwab ETF, SCHQ. You should not buy it, because if I buy it, you know it's going to go down. Hasn't yet, but it will, inevitably. So again, Kathy Jones over at Schwab says, we suggest investors who are looking to add more yield to their portfolio stretch their duration, expose you to more interest rate risk with bonds that have low credit risk, such as treasuries. A bond ladder strategy can be an effective way to average in the market. So long-term treasuries. Interesting. That's what I did. Now, you do whatever you want. Then my comment says, she never actually said who or why bonds are bond yields are falling. She doesn't say who actually is buying the bonds to make the bond yields fall. We all know though, it's a flight to quality. Flight to quality. These governments all over the world are buying up our debts, pension funds. It's not just mom and pop, Prairie Mark and Josh here. And it's everybody and their mom looking to defend themselves against future risk they see coming down the pike, rightly or wrongly. Anyway, it's pretty interesting. Good article. I thought I'd share that with you once again. Psh, for your old buddy Josh, for Prairie Mark. I'm just goofing, man. I'm just goofing. I will see you.